What's up, everyone? My name is Ale. Welcome back to my world of stocks. So, I know that a lot of stocks in the market right now are very expensive, but in today's video, I picked out 5 specific stocks that I not only think have a ton of long term potential, but that are currently down by a huge amount, meaning their prices are super attractive. Literally every single stock in today's video is down at least 40%. Most of them are down over 50%, so more than half of their value, leaving what I feel are some very attractive prices. So it's going to be a super fun video. I hope you guys enjoy this. Hit the like button if you do. Let me know if you'd like to see another video like this in the future. I can do some more stocks for you guys, but please just do me a favor. Please always do your own research and make your own decisions. I'm just sharing my opinion. Yes, these are stocks that I really believe in long term, and I'll be betting on most of these myself as long term investments. But there's a reason why they're down so much. So there is a lot of risk here with every single stock on today's video. Make sure you understand that. Do your own research, make your own decisions. Don't just buy a stock because I talk about it. But anyway, with all of that said, let's just go ahead and jump straight into this list. Okay, so in no particular order, let's just kick things off here with stock number 5, and we'll just kind of count our way down. And right here, we have one of my longtime favorite Chinese stocks in Tencent, ticker symbol TCEHY. And this is, by the way, you're looking at the giant headquarters here. If you're looking at the screen, their giant headquarters in China. It's a pretty cool looking building. Anyway, this is a global video game and various media entertainment giant that usually performs very well. However, more recently, the stock has crashed from around $100 a share all the way down to just the $50 range, which is a crash of over 40% from those highs. By the way, I'm recording this video on Tuesday night. I'm going to try my best to upload it sometime on Wednesday, so just keep that in mind. But when looking at the crash here, there's a couple reasons for this, but the biggest has to do with Chinese regulations as well as worsening conditions between the US and China. Speaking of regulations though, this is something that's really been beating up a lot of Chinese tech companies, especially over the past year. I'm sure a lot of you have noticed this. And more recently, in Tencent's specific case, China ordered them to give up some exclusive music licensing rights that they claim were giving Tencent an unfair advantage over smaller competition. See, Tencent's subsidiary called Tencent Music currently owns over 80% of the music market after acquiring China Music Group, and that essentially gave them a monopoly. You can sort of think of it as a monopoly over the entire market. On top of that, China also ordered internet giants to stop anti competitive practices and fix various data security issues. And look, I totally get why these stocks would sell off. It makes perfect sense because you're taking away competitive advantages from these giants. That's going to ultimately hurt their profits. But at the same time, regulatory sell offs are usually some of my favorite because what it really tells me is that these companies are too hot and too successful to leave unchecked, rather than the company itself being a failure or making a bunch of fundamental mistakes or not attracting customers or losing market share to competitors. It's just literally that the government is trying to slow them down. And to be honest, even though I strongly believe in capitalism myself, I do think that giant corporations need to be regulated once in a while to make sure that they don't run complete monopolies and destroy all the smaller competition and have those kind of unfair advantages. Anyway, that's a deeper conversation to have, especially in China where things get much more complicated and more controversial because of politics and the whole communist government, and there's a lot of different viewpoints on all that stuff and their different practices. But the only point that I'm trying to make here is that Tencent as a business is still doing, a pretty good job, just looking at it from a business perspective, not like ethical or anything else or, government wise. Just business wise, I think they're doing a good job. And despite them having a giant market cap of over $500 billion, that valuation is currently at some of the lowest levels we've seen in a long time for that stock. Plus, they have extremely solid growth on both the top and the bottom line of their financials, and another close to 20% revenue growth both this year and the next. So, with a gigantic and globally dominant business, I just think this is a great buying opportunity for the stock. They have the third largest social media market share in the world world after Facebook and Google, the second most market share of mobile messaging after Facebook, over half of the entire Chinese gaming market. They're the leader in gaming revenue in the entire world. They have the second most market share of Chinese mobile payments, only behind Alibaba, the fifth most cloud market share of infrastructure as a service worldwide. And yet they're still doing all kinds of different innovative things like working in robotics and the Internet of Things and artificial intelligence and so on. So you add it all up, and Tencent is not only a stock that I love to own myself, it's probably one that I'll be buying even more of during this downturn in Chinese stocks. Moving on to stock number 2, though, that's going to be a huge play on the future of healthcare and medicine, and that is the largest telemedicine company in the United States. I think it's the largest in the world, and they're called Teladoc Health, ticker symbol TDOC, which is a company that specializes in helping doctors talk with, treat, and diagnose patients virtually without them ever having to leave their home. And that's obviously been a huge benefit during the pepperoni lockdowns where everyone has been staying at home much more often. I personally, I had strep throat one time, and I had to basically talk to a doctor like over the phone and over the internet, and I got a prescription, and it was all done virtually. So I really think that this is the future we're heading towards. And now this initially sent the stock soaring to a high of over $300 a share before it came crashing back down to now just $130 range today, after reporting disappointing earnings in after hours trading. So again, I'm talking about this on Tuesday night. They just reported earnings. The stock crashed some more in after hours trading. We'll have to see if it recovers or how it does on Wednesday. But as it stands of right now, the stock as a whole, it's experienced a huge crash of more than 55% from those highs. Still, if you have the stomach for this type of volatility, I really think that there's a lot of reasons to be optimistic about their future. For one, it's pretty clear that the future of not just healthcare, but really most things in life will be virtual and internet based. I'm personally not a fan of that myself, but I just feel that it's an inevitability, and Teladoc should stand to benefit hugely from it. According to Fortune Business Insights, the telemedicine market is projected to grow from $41 billion in 2019 to almost $400 billion by 2027 at a huge compound annual growth rate of over 25%. That's a very large compound growth rate for an entire large market, very high. Now, to give you some context here, Teladoc only did about $1 billion in sales last year. So it's around 400 times smaller than the market. So there's a huge opportunity for growth here, especially if you're thinking long term. And I think that's exactly what we're seeing from Teladoc. Last year, they acquired InTouch Health, which gave them access to more than 450 hospitals. And after that, they made a blockbuster deal worth over $18 billion to acquire, or basically merge, with Livongo, who is the leader in digital chronic condition management, leaving Teladoc as the world leader in virtual care with over 50 million paid members and over 10 million medical visits last year. Not just that, but they're growing their sales at an insane rate too. Now, it's true that their latest earnings disappointed and losses were heavier than analyst expectations, but a lot of that was due to the Livongo acquisition. And even though their valuation is still a bit pricey, as they are not currently profitable and their price to sales ratio is over 12, which is pretty high, that PS ratio, that price to sales ratio, can actually come down pretty quickly when you're growing at these huge rates. See, last year they grew revenue by almost 100%, and they're still expected to grow by another 84% this year, and then another 29% the year after as well. And honestly, those growth rates can go much higher, than 29%. They can be much higher in the future years. So at those rates, and again, knowing how large the market opportunity will be for them long term, I think today's prices for Teladoc actually seem pretty cheap to me. And even though it's a stock that I do not currently own myself, it's one that I am super tempted to start buying. I may have to start doing that. Okay, now stock number 3, we got to go back to China here to find what looks like another incredible deal. And here we have the sort of Google of China known as Baidu, ticker symbol BIDU, who, after seeing a sharp recovery in the past year, soaring to over $350 a share, has since crashed back down to just a $150 range. That's a giant crash of more than 55%. Like Tencent, this is all due to China's new regulations and scrutiny of giant tech companies in the country rather than Baidu itself, not operating well, or there being some big competitor dethroning them or anything like that. It's all just kind of government related. In fact, Baidu remains as dominant as ever with a massive almost 80% market share of search engine in China. It's a huge market to digitally advertise to, as China currently holds the largest population in the world at close to 1.5 billion people, making up close to a fifth of the entire world's population. Now, contrast that with the United States, who, even though they're in third place, they only hold less than 5% of the world's population. So you can see how massive China is. Now, this has resulted in huge sales and profits for the internet giant, who usually claims over 100 billion yuan in sales and over 20 billion in profits per year. Granted, there's not a huge amount of growth happening there, but coming off of last year's recession, Baidu is expected to see a whopping over 20% revenue growth this year and yet another 15% plus next year as well. And by the way, their profits would be a lot higher if they weren't busy reinvesting them all the time to become even more dominant, like they are with their cloud computing segment that is only surpassed in Chinese market share by other giants like Alibaba, Huawei, and Tencent. Or you can also look at their massive work in artificial intelligence. I've mentioned this a lot of times on the channel, where they currently hold the most artificial intelligence patents in the country among both domestic and international companies. They continue to work on advancing things like data science and mining, robotics, machine learning, computer vision, quantum computing, and even autonomous driving, which, by the way, they're arguably the biggest play on autonomous driving in China, as they were the first to test robo-taxis on the street, and they're even now partnering with BAIC to put over 1,000 robo-taxis on the road over the next 3 years. Add it all up, and a giant company like Baidu trading for a PE ratio of less than 8, that is 65% cheaper than the sector. That is way too cheap in my opinion, and the stock looks like a screaming buy considering the large future potential. Despite already owning a decent position myself, I'm going to be adding to this one at these prices. Okay, now moving back out of China though, if you're someone who is completely opposed to owning Chinese stocks for whatever reason you have, communist government, whatever, ethical reason you have, then stock number 2 here, I hope I've been counting them down correctly. We went from 5 down to 1, so we should be at stock number 2 now. Stock number 2 here, this is a company that actually refuses to do any business with China, which is kind of crazy, but they are a US sort of like special intelligence company that mostly only partners with Western countries and allies, and that's going to be Palantir Technologies, ticker symbol PLTR, who does a lot of big data analytics, works on counterterrorism, and is essentially trying to become like the operating system of the US government in a lot of ways. Now, despite being awarded huge contracts with the US government and even large corporations in really just the past year, many of which of these are worth tens of millions of dollars, some, even 100 or more, the stock is actually, it continues to take big hits, and they are currently down now by over 50% from their highs. Now, a big reason for that, though, was because the stock was just too high to begin with, as Reddit-fueled rallies sent the stock soaring from their IPO of late last year. And even at today's lower prices, the valuation is still very rich at a price-to-sales ratio of over 25. Remember we talked about Teladoc? That was at 12 or something like that? So this is like more than double Teladoc. So it's a very rich valuation. Still, compared to prior highs, it's actually not that bad, as it's lower than the median of 28. Plus, you have to consider the huge opportunities for the future. Governments have the biggest pockets in the world. I think we all know that. And the nice thing about Palantir is that their platforms and services can be used by practically anyone, not just the government and military, even though that is where they're going to be making a ton of money. But just looking, for example, pharmaceutical companies, they're already using Palantir to research cancer and other illnesses to develop new drugs and treatments. Bankers and insurers use it to detect fraud. Auto manufacturers use it to improve quality control. There's even aviation companies like the giant Airbus that use it to improve their supply chain. I mean, the list really goes on. Meanwhile, sales are growing by over 30% consistently every year, which, by the way, I think is a super low estimate for years to come, considering the huge ramp up of data analytics. I mean, IBM recently stated that 90% of all the data in the world was created in just the past 2 years, with 80% of it being unstructured, meaning that data is growing at a gigantic rate and it needs to be analyzed and processed, and that is exactly what Palantir specializes in. And I think the government is going to really use that. They're going to really take advantage of that. Now, they're currently not profitable on a GAAP basis, which does make them a lot riskier than most. But this year, they're expecting to post positive cash flows, and in the future, I think margins will explode as they begin to dominate the market and get those, kind of software services margins that you typically see that are very high. Now, it's still an expensive stock, but I think the price is worth it for the long-term potential. I recently bought this stock myself because it is low, and I will continue to add to my position on some big drops. Okay, now finally, you guys know that we couldn't make a discounted stocks video and include other Chinese stocks without even mentioning the most obvious buying opportunity in China right now, at least in my opinion, and that is, of course, Alibaba, ticker symbol BABA. And it's really been crazy how this stock just continues to crash. I mean, there are some small recovery days, but for the most part, Alibaba has been in a downward trajectory for months now, leaving what I feel is one of the most obvious buying opportunities I've seen in a long time, as they're currently down over 40% from their highs, and personally, I'm loving every minute of it. This is a giant e-commerce behemoth that commands by far the most market share in China, at over 3 times larger than the next closest competitor. They dominate the cloud computing market with almost 40% share as well, and they even control the digital payments market in a duopoly with Tencent at over 55% share through Alipay, which they own about a third of, that generated over $750 million in profits for Alibaba last year. I get that the regulatory concerns are a little more serious with Alibaba, since it really does feel like China's kind of trying to make an example out of them by finding them a record amount. They halted an IPO, but the record amount, it was like nearly $3 billion. A lot of other tech giants got off much easier, but even then, at nearly $3 billion, it was still only about 4% of last year's sales, and this year, Alibaba is expected to generate over $140 billion more than that, with revenue growth that is still over 30% despite their already massive size. My gut tells me that this sell-off of Chinese stocks is not going to be over for a while, but I'll be buying all the way down in small amounts because it's my favorite thing to do as a long-term investor, and I gotta say, Alibaba is at the top of this list, at least for Chinese stocks. Okay, so there you have it, guys. That's my list of 5 stocks that I think are trading at some pretty attractive prices at the moment. Let me know if there's any stocks that you think should have been on this list. I would love to hear about those. And hey, you know what? If you leave those down there in the comment section, I almost certainly can add them into a future video just like this. So make sure you leave them down there. I'm always looking for more opportunities myself. I'll research them for you guys and I'll throw them into another video. So make sure you leave that comment and hit the like button if you enjoyed the video. Thank you for the support, everyone. I hope you're all doing well out there. Take care. Bye-bye.